All right. Hey, guys. Welcome back to We Talk Money. My name's Chris Dunn. I'm your host, and I am joined by my two awesome guests. We've got Travis DeVitt, hedge fund investor pro, and we've also got Nikki, who's a certified financial planner and active investor. Crazy times we're living in, guys. Today is, what's today? Friday, April 10th. It's hard to even know what day or week it is. It's all just kind of running together.
Every day I'm like, what day is it again? I have no idea. It's all running together for sure.
Weekend, weekday, it's all the same now.
It's all the same.
Yeah. Well, let's just go ahead and jump right into it. I'm going to label this episode something like it's Bitcoin's time to shine, because it really is. I mean, we've got a really weird global economic situation that is really kind of perfect for Bitcoin to show what it can do. So why don't we just go ahead and just jump right into the charts and the data and talk about what's happening, where we are, and why I'm putting forward that thesis. So let's start by just talking about the big elephant in the room. And I know a lot of people have been paying close attention to this, but the coronavirus cases a few minutes ago, as of this website, we officially crossed over 100,000 deaths, which is extremely sad. We're coming up on nearly 2 million confirmed cases. The reality is that's probably a lot higher than that. You can see the U.S. is still leading the world in new cases. Anyway, guys, let's just jump into the markets. Let's talk about all the economic stuff that's been happening recently.
Yeah, big stock market rally this week, and it surprised a lot of people. I see a lot of interesting negative reactions to it, actually, which is a little bit surprising to me. But yeah, the markets had a good week, and that was really shocking to a lot of people who are still trying to grapple with a market that's doing well, with, you know, an economy that is really struggling to get off the mat. So
yeah. So looking at a weekly candle here, we only had 4 days of real trading activity, I guess, with the markets closed today. We were up about 12%. Looking at the technical chart, I mean, I have reasons why I think we did this. And I actually, in the trading room, was calling for basically a 50% Fibonacci retracement on the technical chart. But do you guys want to talk a little bit, I guess, about fundamentals, or at least just what is the story? Why did the markets make a climb higher?
Well, I think, you know, I think for one, obviously there's the impact of the fiscal and monetary stimulus is certainly helping. So that is clearly a benefit. It's taking the worst case scenario off the table for a lot of companies. There's also, you know, a lot of buying from people who are kind of FOMOing into the rally. There's a lot of stocks that were very beaten up, down, you know, anywhere from 40 to 80% on some of these stocks. And so they, you know, were in a period where, you know, they finally could get a bounce. And once that started, like, there was a lot of not only short covering, but FOMO buying and things like that. So that's obviously contributed. But you know, it's really also important to understand that stocks don't just reflect the value of what's going to happen or what they're going to earn in the next 6 months or 12 months. You know, stocks are long dated assets, and, you know, they reflect the value of what a company is going to be able to generate in cash flow for its shareholders over 10, 20, 30 year timeframes. So, you know, when stocks are down 40%, reflecting, you know, a lot of near-term pain, obviously, and an expectation that they're not going to earn as much money for the next few years, you know, that makes sense in some sense, but it also doesn't make sense that a stock would continue to go down, because, again, we have to remember that the economy eventually likely will recover. Companies will see earnings increases again a few years from now. So we have to remember that that is an important thing to understand about companies and stocks.
Yeah. And that leads us to our first question from Amanda, which is, since the coronavirus is causing so much unemployment and companies to lose money, why is the stock market going up? And I think we kind of answered that, which is, you know, a combination of, you know, FOMO buying, the stimulus package. Is there anything else that's contributing to that you think is important to point out?
I think personally, it's like you said, it's a mix of different things. But to add to that, the fact that the market could just be extremely forward-looking right now. It could be forgiving 2020 in a sense and looking towards 2021. And we also have something I've seen before many times. We've got everybody on the same side of sentiment. I mean, everybody is bearish. Find me one person that's bullish right now. It's very hard. Yeah, well, no.
The optimist in the room. It's a very unpopular opinion.
Very.
But I've said this over the last few episodes. especially in the crypto community. It's not a popular sentiment, but, kind of jumping back to that, talking about Bitcoin, I do think even though stocks are somewhat bullish and they could absolutely have more downside, I want to talk about Bitcoin's price because I think that this is really its time to shine, with unemployment numbers obviously going to insane record levels, right? Like just a couple of weeks ago, we were floating around a couple 100,000 claims. And then, this chart is just absolutely ridiculous where we went from 3 million to 6 million and then another 6 million this week. So obviously the ripple effect of the virus and really the global economy shutting down is having an unprecedented reaction, right? And so I think it's rightfully so that, a lot of people are bearish. It's just how bearish for how long. And in the short term, Bitcoin's got a halving coming up in about a month. And with the stimulus package and a lot of people just waking up to the fact that the Fed can print at its own discretion trillions of dollars, people are now in the mainstream starting to question what is money. And is fiat currency real money, or is there a better option? What do you guys think?
Yeah, I've seen a lot of that this week. Obviously, we had, Chamath was on CNBC, had a really, widely publicized interview that kind of went viral, talking about, a lot of the monetary stimulus and some of the negative, implications of that. And, there was also some newsletters all over finance Twitter or FinTwit. I was seeing negative takes on what was going on with the monetary and Federal Reserve stimulus. And so, I think there's a lot of angst over that. And a lot of people that think that with the flood of money going into the system, that's going to have repercussions for all kinds of financial markets from stocks to Bitcoin going forward.
And I know one thing you've been working on today is a article for your newsletter that we can link up. But the title is "Please Step Away from the Ledge." Do you want to talk a little bit about what you talk about in this article?
Yeah, so it is kind of a counterforce reaction to a lot of the just emotional knee-jerk reactions I'm seeing and the anger that I'm seeing in the market right now about the market going up. It's as if, like you said, Nikki, that everyone's positioned bearishly. People are losing their minds on Wall Street Bets subreddit, for instance. Like they're all positioned very bearishly. They've all, seems like a ton of people have lost money this week. And now you've got these emotional posts about, how the American economy is just totally, screwed and companies aren't being responsible and all this stuff. And there may be a hint of truth to what they're saying, but there's so much emotional misunderstanding of what's going on right now that I wanted to create the post to kind of walk through what's actually happening on the ground and have a more rational take on why this market rallied and what is going to happen going forward.
So what's the general, I guess, idea behind this? Obviously there's fear in the markets, which is understandable, but what is the other side of the argument? And, again, for anybody that's new to the show, one thing we really try to do is look at both sides objectively, right? To step outside ourselves, step outside our own biases and our own beliefs and ask like, hey, what is the reality of what's actually happening? And what are the possible outcomes? Because, when it comes to macroeconomic stuff, like we all have our beliefs, and money in itself is a belief system, and that belief system is getting challenged right now on probably the biggest level that it has in human history. But what is the counter argument here? And what advice would you give people that are looking at this going, what the hell is happening and what do I do?
Yeah, I mean, I think the first big piece of advice, like we've talked about on the show numerous times, is that, if you have a really severe, emotional bias on the market or on, different assets, that can really hinder your ability to grow your wealth. It's like you've said many times, Chris, you've got to be able to really understand the possibilities and the probabilities of different scenarios. If you take a really extreme view, like we're headed for depression and everything's, about to crash, then it's very possible if you're positioned just for that scenario, then you're going to be in trouble if that doesn't happen. And we're seeing that now. We're seeing that with the Wall Street Bets people who were bearishly biased and thought the market would just keep going down forever. We saw it after the great financial crisis in 08, 09. People were calling for hyperinflation or depression. And, it turned out that there was a middle path and actually, things recovered over a period of time. And so I think, it just makes sense to try to have a rational perspective rather than a really singular, emotionally driven perspective about what the world should be. We as investors, putting the investor hat on, we have to look at things with a rational mind and understand what could happen, not what should happen.
Or what we want to have happen, or what our small friend group or our Twitter followers, kind of the circle jerk of like agreement. And, I don't know. I think one thing that would be really interesting is to take a look at the S&P by market cap and also talk a little bit about the stimulus package. But one thing that I thought was really interesting, and maybe why the stock market hasn't gone lower than it already has, is just looking at the companies that have basically dominated a lion's share of the total value of the stock market. If you look at these companies, Apple, Amazon, Google, Microsoft, Facebook, these are companies that maybe aren't being completely demolished or even hurt that bad during this coronavirus.
Yeah,
absolutely.
Yeah. It's a great point. And that's one of the reasons why too, when we look at headlines, if you don't look deeper than the headlines, you might not understand why the market's rallying. Like you said, like companies like Amazon, they're actually seeing an increase in their e-commerce business right now. Microsoft is seeing an increase in, work at home Office 365 subscriptions in their cloud Azure business. We could go on with some of these companies, right? But they're actually holding up pretty well from a fundamental perspective. And they make up a large percentage of large indexes like the S&P 500, the NASDAQ 100. And so when you see those outperforming or going up, you can understand that a lot of that may be driven by the way that the indexes are constructed. So that's important to understand. Like you have a chart here that I'm actually including this graphic in my newsletter post this week, which shows the performance of the NASDAQ 100, the S&P, and the Russell 2000 since the start of the year. And you can see that like the Russell 2000, which has a lot more smaller cap companies, and it doesn't have that overweighting with the big tech companies, is actually down a lot more than say the NASDAQ 100.
Yeah.
And so we do see that
for anybody just listening on the podcast, so we're looking at a chart that's showing the small cap Russell 2000 is down as of today about 25%, where the NASDAQ 100 is only down about 5%, and the SPY is down like 13%. So the larger companies in essence are, because they're more profitable, especially right now, and they have more cash and their values aren't hit as bad, those indices are not down as much as like the small cap index. Is that how you would say that?
Exactly right. Yeah. So even though we're seeing the market rally quite a bit this week, there are still stocks that are down 20, 30, 40, 50% year to date. It's important to remember that. It's not like every company in the market is being bid up to like new all-time highs.
Yeah, good point. So let's talk a little bit about the stimulus package and the anger that's around that, which again, I think some of it is justified, but some of it might be overblown or just misunderstood. What do you guys want to say about that? And maybe we can talk a little bit about what, Chamath said and some of the cruise line stuff.
Yeah. So Chamath was very upset and vocal about the fact that, he thinks that we should be letting companies fail. And I've actually heard this a lot over the last couple of weeks, that we should just allow companies that didn't prepare for a scenario like this to go through bankruptcy process or restructuring. We shouldn't be, giving them loans or grants or anything to try to help them survive. And he says, if we do that, then, helping them survive is essentially just helping hedge funds and stuff like that. So I understand some of that sentiment, but he's wrong in some respects. Like he actually mentioned that, we shouldn't be bailing out cruise lines. Well, we're not bailing out cruise lines. The government packages have not included any kind of aid for cruise lines. And what you were just showing there a minute ago, we actually saw Carnival Cruise Lines this week go out into the market and raise new equity and debt capital. And it's pretty expensive capital, 11.5% for their bonds. They also raised new equity capital, which dilutes the current shareholders at, a much lower price than it was trading at a couple of months ago. So they went out and got private capital to try to fill the gap. And so I think we should see more companies do this. I think we will see more companies do this. Not every company is just getting free money from the government.
So in layman's terms, what does that mean? So like a lot of people think in terms of like, okay, you have a private company and then you have the government. And a lot of people thought this about the great financial crisis too. They thought that the government was just giving these companies free money. Is that true? And then the second question is what does that mean when a company goes to the public markets and tries to raise capital and equity or debt?
So the term bailout, I feel like it can be misconstrued and kind of misunderstood by the public. You hear bailout and everyone's just angry over bailouts. But what actually happened in 2008 is these companies, these banks, it was banks, it was insurance companies, and a few other industries, and they were given loans from the government. So it wasn't free money, and these industries had to pay the money back. And all of it was collected back. The auto industry lagged behind a bit, but not only did the government get back the money, but they also made money on the money that they lent out as well. And then they also did things like the government would buy preferred stock in the company, in the companies that really needed that influx of cash. So it wasn't just free money that these corporations never had to pay back. I think that's the biggest misconception around the bailout process. Granted, there are grants that we've been talking about that will be forgiven, essentially. But for the most part, these companies are looking for loans that they're going to have to pay back to the government.
Awesome. So you've got loans, you've got grants. Travis, I'll kick this to you about, specifically like the Carnival capital raise. Like what does that mean? And like whose capital is at risk when they go and they raise equity and debt from the public?
Yeah. So that's, private shareholders and debt holders that are providing capital to the company, new capital. So that helps them raise new cash that they can use to, pay for the ongoing expenses of the business. And again, this is not like any kind of bailout related type of capital. This is, new investors coming in and providing capital to the company. And now they have, new bonds or new equity that is just private market driven. So this is what you want to see with a lot of companies. And what, Chamath would say all companies need to do, they either need to, sell stock in the open market like Carnival did this week, or they just need to go into the bankruptcy process. The problem I have with this is, most companies did not plan for a pandemic type of situation where the physical economy was literally shut down for 2 months. And the level of cash burn that creates for companies is higher than they could ever anticipate, like in a normal recession. So that's number one, important to understand that most companies could not have or did not plan for this. The other thing too is that if we were to try to allow companies en masse to fail all at once and go into the bankruptcy process, that would create a deflationary depression. So if one or two companies goes through restructuring, it's fine. They can have their debt converted to equity. They can get what's called a DIP loan to help provide them capital during the bankruptcy process. And they can come out the other side, a restructured entity, and maybe the equity holders get wiped out, but the bond holders actually become the new equity holders. That's what we see in a normal restructuring. But to have like an entire industry, like the airline industry, fall into bankruptcy at the same exact time, also during a time when the economy is basically shut down, is just a catastrophic outcome that the system can't really handle all at once. It's sort of like the hospital situation with coronavirus. If you have it all happen at once, the system can be overwhelmed and create second and third order effects that make the problem much, much worse. So that's why we're having an attempt at the federal level to have a stopgap, to have bailout loans that can provide large amounts of capital that can help these companies work through the crisis period and then come out the other side still solvent and still employing hundreds of thousands of people.
Yeah. So it sounds like it's a balancing act. On one hand, it's like, okay, do nothing, give nothing to these companies, offer no help, but the risk there is a depression, right? Like that's literally what happened in the 30s is the government did what the opposite. They were actually raising rates, right? They did nothing to help. And
tightening money supply.
Yeah. They were tightening and then like we saw in 2008, okay, well, they went the opposite direction. But then the risk with that, and I think the problem that a lot of people have is they start to question, okay, well, how valuable really are these dollars? And then what are like the short-term implications are, okay, we put a stopgap, we help the economy in the short term, but what's the longer term implications? Is that going to lead to higher velocity of money, which is going to lead to high inflation or even hyperinflation? Do you guys have any opinions on that?
This is essentially an MMT experiment, if you will. I mean, would you guys agree that this is kind of the start of us experiencing this firsthand? There's been arguments back and forth, between the different monetary belief systems and how it should work. And now we're finally seeing the Fed just basically print money out of thin air. And
what is MMT before we go any further?
Well, modern monetary theory is kind of an economic theory around the idea that governments that control their sovereign governments that control their own currency are not at risk of defaulting on their debt, and they can actually use that ability to create money to help stem declines in the economy, pay for social programs, and basically support the economy in ways that a lot of traditional economists wouldn't typically understand under the like a gold standard type system or some other system,
or sound money or hard money, right? So it's literally like the exact opposite of the belief system or the value prop of Bitcoin, right? You've got governments that are saying like, we actually we can print an infinite amount of money and it really doesn't matter because we're the government. Is that the best way you guys could think of saying it in layman's terms?
I would say so.
Yeah.
And it's going back to your argument about, is this Bitcoin's time to shine? And that's the thing. People that are maybe afraid of what MMT policies could do, hyperinflation, et cetera. I mean, we don't even really know truly, right? I mean, everyone thought we were going to see inflation with quantitative easing from 2008, and we didn't. So everyone has theories, but I guess nobody really truly knows what's going to happen. But to your argument about Bitcoin is, I would imagine this would make people kind of want to flood to Bitcoin, or it could make it potentially an irresponsible decision not to have some Bitcoin to kind of hedge against what we could see with new monetary policy.
Yeah, because the more people that wake up and realize like, hey, these dollars really are just created out of government's whim. And I guess there's some argument for that, but really, if you look at what money really should be, one of the key characteristics is it's scarce and it's hard to get and it's hard to make. And the more that you mess with that, the less hard money really is and the less valuable it becomes over time. And that's why we've seen really just a massive devaluation over time through inflation. I don't know, Trav, what's your opinion on that?
Yeah, no, I think that's right. I mean, we do have to look at the scale of the money creation relative to the economy. That's why we didn't get hyperinflation after 08, 09, because the economy was in deflation as it is currently, right now in April 2020. And so the money printing it's being done to offset that, to try to prevent the snowball into a deflationary depression. And so that's why we typically don't see hyperinflation when money is being printed in these types of environments. Now, when you see countries that go crazy with the printing press, and let's say they create, a 50% larger money supply, like in a Zimbabwe type situation, then that's, yes, when you can get hyperinflation and a runaway, increase in the monetary base, which creates, a really perverse set of situations in the economy that can really screw things up. And so my whole thing is trying to understand, for when we look out 2 or 3 years, what is the monetary stimulus going to look like and what does that mean for the economy? And it's hard to know. It's hard to know exactly what this means. But I think that's what, like you said, Nikki, gives you an opportunity to own assets like Bitcoin and gold as hedges. And it doesn't have to be one or the other. You can own stocks and Bitcoin, stocks and gold. That's
Absolutely.
why. Yeah. We try to position ourselves to benefit from different types of environments. You don't have to take an extreme view.
And that's why I think, I think we talked about this last week, but just thinking of your overall portfolio and knowing that we're looking at an uncertain future and realizing the risks of the fiat system, but also knowing that hopefully it's not going to completely fall apart. But if it does, having Bitcoin and gold and other physical assets as a hedge. And, again, just kind of looking back at the Bitcoin chart, if we look at a weekly chart, we can see that the 8K price point has really been a magnet for the past 3 years. You can see for the first time in 2017, we crossed above 10K, and then we really used 8K as what I call an over-under magnet, where every time we get below 8K, we find support and move back to it. Every time we get above, we move back down to it. So it's really act as this magnet. And right now, in about 30 days, we've got a halving where the supply is going to get cut in half. And in theory, that should drive prices higher, but it's not exactly that simple, right? The demand side still has to be there. And so we'll see. I mean, we're coming up very, very close, and we just today seem to be hovering around that 7 to 8K price level. So the next few weeks will be very, very interesting to see how price reacts to this level. On the other side of the proverbial coin, we've got metals. And if we take a look at gold, just taking a look at a weekly chart of gold looks extremely bearish. If you look down at a daily—
Bullish, you mean?
Bullish, you mean?
What I said, bearish?
Yeah.
I don't even know what day it is. Yeah, it's a very bullish chart here on the daily and weekly chart. You can see this inverse head and shoulders, almost like a cup and handle, and then we broke out to a new high. And really, the price of gold, the only major currency that it hasn't hit a new all-time high is the dollar. If you look at, Canadian dollar, if you look at the pound, if you look at the euro, like gold has recently broken out to new all-time highs. And I think this is because, over the past few weeks, we've seen a flight to quote unquote safety of the dollar. And if we take a look at the dollar index, this has actually been really one of the only fiat currencies that's remotely been holding on. So we took a look at a couple of markets here. Let's jump into some Q&A. The next question is from Ryan, and he was asking, so Travis, I think a couple of weeks ago, you said a stock buyback is really just like a dividend by a different name. Said, please explain, why isn't this BS? A stock buyback is a way for companies to artificially inflate the price of their stock. It's also a very large reason as to why this free fall in the market is so drastic. When a company lays off employees with a lot of experience like Lowe's, who just wants to free up more cash for stock buybacks, it's definitely not a different word for a dividend. Why don't we explore that a little bit? Because I know this has been a really hot topic in the general conversation around the markets recently. So Trav, do you want to expand on this?
Yeah. So there's a technical explanation for this quote, which is, Modigliani and Miller are two academics that actually proved through, actually some mathematical models that a stock buyback is really just a dividend by a different name. And I can kind of quickly try to explain that. A company can return capital to its shareholders two ways, basically through a buyback or a dividend. And so if you think about a company doing a normal dividend, normal cash dividend, they pay you as a shareholder, let's say you get $1,000 in dividend for the year. Now you can go take that cash and put it in some other asset, or you can take that cash and actually buy more shares of that same company and end up owning a larger percentage of that company. So in that sense, a dividend can be used to sort of look like a buyback. A buyback is just the company taking that cash, and instead of paying it out as a dividend, they go back and they buy back stock from some holder who wants to sell to them. And the remaining holders then own a larger percentage of the remaining company. So again, from a technical perspective, a dividend really is just like a stock buyback with a couple of small differences. Now, buybacks are an extremely misunderstood subject, because people think that companies just do them to try to inflate their stock prices. That may be true in a couple of cases, but generally that's not true. A company generally has a waterfall of how they think about capital allocation. They're always going to invest for growth in the business first. So, paying operating expenses, doing capital expenditures to, add new assets, buying other companies through M&A, paying debt down. Those are things they're going to do first and foremost. After that, if they have cash flow left over, that's when they're going to think about whether or not they should, do dividends or buybacks typically. And so
to kind of break this down for the layman, so you have a company that makes money. They have expenses, and then they end up with profits, right? They have cash flow after everything's said and done. So you're saying from the top to the bottom of this chart. So priority number one is add, like give raises, CapEx, like buy stuff, basically grow the business. Right? That's priority number one. And then priority number two is to pay down debt. Yeah,
typically you'll see most companies prioritize it in this waterfall. And so the idea that companies would lay off employees to do stock buybacks, I've just never really seen that. I've seen a couple scenarios with some private equity backed companies where they actually did take out debt to try to buy back stock. And that was a really perverse scenario. And I don't like leveraged buybacks, and I don't like when companies do that. Some companies have also used buybacks as a way to offset share dilution from the shares that they're giving to management for incentive compensation. Those are bad buybacks. I think we can have criticism over that. But criticizing buybacks more broadly is, I think a little bit erroneous, because again, a lot of companies, like look at Apple. Apple has, hundreds of billions of dollars sitting on its balance sheet. Why shouldn't shareholders have either a dividend or buyback to give them back some of that excess capital? Apple's already investing in lots of different areas. It's hiring, it's trying to invest for growth, and it still has all this excess capital. Apple, by the way, actually is a large share buyback company. And so it, sometimes skews the actual total numbers of buybacks across the market because it is so large. But, Apple stock was trading at a below average market multiple over the last few years prior to I think 2019. And so it made sense to buy back stock at a reasonable valuation. So those kind of scenarios, I think, make sense for buybacks. Again, I think there is valid criticism against the way that some companies do buybacks, but I've seen very few companies ever actually lay off employees to try to do buybacks. I've actually never seen that. And right now, in this current environment, we've seen a large increase in the number of companies that have been suspending dividends and share buybacks to retain that cash on their balance sheet to try to get them through the crisis period. And that is absolutely the right decision. Companies should not be paying out dividends or doing share buybacks right now. They need to survive first. Yeah, again, I think this is another one of those nuanced topics that if you dig a little deeper, it won't be quite as dramatic as you think.
Yeah. So there's definitely people that abuse it, and those tend to get highlighted in the media, which gives kind of the whole practice a bad name. But in general, if you understand why it's there, the whole thing and what everybody is doing is not necessarily perverse. Awesome. All right. So next question, Ronnie asked, I missed last week's rally because I was scared and stayed in cash. Now I'm wondering if this was the bottom and if I should buy stocks here. So that's kind of the key question that you get in a pullback, right? Is, okay, the market's going down. And this happens in Bitcoin too, right? Like we were buying the latest dip when it crashed from 8K to 4K. And a lot of people are now looking at it at 7K going, oh, should I have bought the low? And we talked about this in prior episodes, how it feels weird to buy when the market's crashing or when prices are going down, but that's really the best time to do it in a lot of cases. So what would you guys say to somebody who says, look, I was scared as prices were crashing, as a lot of people probably were feeling, rightfully so, but now it looks like a bottom could be in. We don't know, but, what do you think about buying stocks at these levels?
Long term, we will get out of this. We will recover from this. There are still a lot of stocks that they're not recovering to the same degree as the market has. So there could still be some opportunity to find in the market in other stocks that haven't matched the recovery we've seen in the S&P. Trav, do you have anything to add to that?
Yeah, I think you pretty much hit the nail on the head. But if you're thinking about if you're sitting on a large cash pile right now and you're thinking about deploying it, part of that depends too on whether you're trying to get into something like a broad-based market ETF, or if you're trying to specifically pick some stocks that are undervalued. The market as a whole right now, from this point forward, depends on the time frame, right? Over a long-term time frame, I think we'll be well above this level in say 10 or 20 years.
Right.
But if you're trying to predict the direction from here over the next 3 to 6 months, I'm not sure. I do think maybe the market rallied a little bit too far, too fast, possibly. Mm-hmm. But there are, like you said, some really undervalued stocks still out there even today that should do well over the next couple of years. So yeah, it kind of depends. And I think you can dollar cost average into ETFs or into some of these stocks that are undervalued, scale in over time so that you're not picking one moment in time to try to put all that capital to work.
Yeah, I think that what I'm noticing from a lot of people is they're just so one-sided and biased with, we haven't seen the bottom. Like, we're definitely going lower. We're definitely going to see more lows. And I think that type of mentality could be a little bit dangerous here. I think there's a possibility that the low is in, right? And if that's the case, I would say try to plan for both scenarios from here. And maybe that's just deploying a little bit of capital. And then if it goes lower, we deploy a little bit more, just trying to think of it in that way.
To add to that, I see that also in the crypto space, like with Bitcoin. I get the question every single day of my life, which is, hey, should I buy Bitcoin here? And people are always trying to pick exact bottoms. And the idea of scaling in and saying, look, I don't know, right? Like releasing that, because that's something that's outside of your control. But if you look at in the stock example, where, fundamentally where valuations are at and where they could be, and think out into the future. And then the same thing with Bitcoin. Look at prior market cycles, look at things like stock to flow ratio, look at the growth over time, and look at accumulation ranges and add at those key moments, instead of just saying, like Trav said, I'm all in or all out at these certain levels. We're dealing with an uncertain future, right? We're making bets with incomplete information. And so to do that, when you break up your orders in your capital base and you scale in and scale out, it removes that need to be perfect or to be right.
Exactly.
Pick exact tops and bottoms. And if you try to do that, you're opening yourself up to a lot of room for error.
One thing that I say a lot is think about just getting the meat of the move, right? Nobody can pick exact tops and exact bottoms at all the right times. Yeah. I mean, some people maybe, but they're most likely just getting lucky. Just try to get the meat of the move and try not to think about perfection.
So, to kind of wrap this up today, I know this is a very weird time for a lot of people. We've got on one hand, I put on my like philosophical hat, thinking and talking about like the concept of money, right? Like that's what this show is at its core, is talking about what money is, how it works in society. It's a social construct. It's something that human beings created, right? That this isn't like some law of the universe that, Bitcoin is true money or gold is true money or dollars are true money, right? It's whatever we decide it is. And I think it's just really important to have that conversation right now, because a lot of people that have never really considered questioning the financial system before are doing that today, right? So it's a pretty interesting time to be alive. And on the other side, we've got our investor hats, right? Which says, working with the information that we have today and looking at the way that the financial markets work today, how do you invest in a way that can build wealth for you and your family, right? So I don't know. That's just something I've been thinking a lot about. And obviously on the philosophical side, I think about wealth inequality and, things that the Fed are doing that might make that worse. And also, just the concept of money, that maybe people are waking up and realizing that fiat currencies aren't going to be the money forever. I don't know. Do you guys have any other thoughts or anything you want to add to that?
That's some deep stuff.
It is. It's literally, it's what makes the world go around. And, it's probably the second most important thing next to your physical health and mental health.
It's interesting. And one of the reasons why I tend to be an optimist as kind of my default, sort of thinking about the world, is that like, no matter what that money is, I think humans want to transact with each other. They want to create goods and services. And so like this economy sort of exists no matter what that source of, true money really is. And, I think when you're owning good, solid, scarce assets, whether that's a company that, produces really great products and services that can deliver value to its customers and shareholders over time, or it's something like Bitcoin, which is a scarce digital asset that can be transferred instantly across the world. Those are both things that from a more fundamental standpoint are worth owning because of those things, regardless of what you think the Fed is doing or what you think the economy should look like or whatever. Like if you focus on that for a longer term time perspective, I think that gives you some clarity over trying to predict market direction with all the news that's flying around.
No, I mean, I think that's why I've mentioned earlier, I'm wondering if with all the changes and all the new things we're seeing, I'm wondering if it's going to become one of those situations where everybody, should have a little bit of Bitcoin just in case, It's definitely proven to be a very resilient asset. It makes me think, I can only think kind of bright future in a way with the way that it's been so resilient. And then as this is unfolding with our currency, fiat currency. So that's kind of what I'm thinking.
Yeah. I mean, it really is the honey badger of money. And every couple of years we go through a cycle where the mass media calls for the death of Bitcoin and you get all these obituary articles. And then, 6 to 12 months later, it's at new all-time highs and people are euphoric about it. I mean,
isn't that almost every asset at this point? I mean, they've been saying that about the stock market. They've been saying it about Bitcoin. Real estate's going to crash again. Like, I mean,
Yeah.
Everybody's got something like that to say about every asset lately, it seems.
Yeah. And even the mainstream money managers are starting to come out with ideas like calling Bitcoin dummy insurance and stuff like that, right? Where if the shit does hit the fan, are you going to really want to own 0 Bitcoin? Like you should,
exactly.
If you're a responsible money manager, a 1% allocation, just looking at the risk and reward profile of Bitcoin makes sense, right?
That's
like,
been the argument.
Responsible if you don't have it, I think.
Exactly. No, that you're correct. That's what I've been seeing floating around the advisor space as well, that they're questioning that, saying, well, maybe we do need to have some.
Did we just do an infomercial for Bitcoin?
I think we did.
Drop gold. Bitcoin is the real new gold.
But this is just showing that you don't have to be one-sided. You can like all assets. You can like multiple assets.
Choose a tribe and go all in on that tribe, and everybody else is wrong. Money is religion, and my religion is the right religion.
What I think is fascinating is what the world is going to look like, a year, 2, 3 years from now. I think we are at a big turning point, like you said, in so many ways, with not only what we're seeing with this unprecedented experiment in terms of fiscal and monetary stimulus across the world, but also what we're seeing right now, currently this week, with the backlash against corporate bailouts and the need, instead of paying people directly, it's been more of the programs aimed at helping companies. And I get the incentives behind that, but it's interesting to think about, what that may change. We may be seeing more of a shift to people that want to support people like Bernie Sanders or Elizabeth Warren, people that want to see a shift from the way that we're structuring society today to favor the corporation to maybe we're going to be favoring the individual, as we go forward. It's interesting to think about.
And maybe redefining how corporations look, right? With decentralized organizations and, DAOs and stuff like that. Maybe a few years from now, we'll be actually redefining what a large Fortune 500 company actually means and what that looks like at its core.
Yeah. And we talked about the buyback thing earlier, and it sounded like I was kind of defending buybacks. And at some level, I was defending it against the blanket attacks against them. But I do think we're going to see a different maybe set of regulations for how companies maintain cash on their balance sheets to prepare for pandemics or what other things could come out of left field. So I do think we will be in a new world of corporate capital allocation going forward. It's going to be interesting to see how that evolves too.
For sure.
Yeah. Well, on that, guys, I think we can go ahead and wrap it up. Feel free to go to wetalkmoney.com to submit your questions. Hopefully everybody's staying safe and healthy. And, also feel free to check out the Skill Incubator's wealth building community if you want to invest with us and be in a community with us on a daily basis. I'll link up Travis's new article that he's getting ready to post today, talking about stepping back from the ledge and maybe learning just how to think a little more pragmatically, or at least view yourself as a casual observer rather than a tribe member of a specific belief system. That's, in my opinion, the smartest investors that I know and that we like to talk to kind of think like that and operate from that framework. So we just kind of encourage people to take that same approach. Awesome. All right, guys. Well, thanks for joining me, you two. And we will see you guys in the next episode.
See you later.
Yeah, everyone.
Bye.